Good afternoon and welcome to the May webinar, Surplus Lines from the Beginning. My name is Julie Mendel and I'm the Education Trustee for the SILA Foundation. Before introducing today's speaker, I have just a couple of housekeeping items for everybody. This webinar is 1 hour in length and is being recorded. Within the next week, you will receive a link to the recording and a post-webinar survey that we would appreciate you completing. We ask that you mute your microphones and turn off your video so the focus stays on our speaker. We also ask that you put any questions you may have in the chat box. We'll be monitoring and posing those questions to the speaker on your behalf, and we will answer as many of the questions as we can in the time we have available. And today's speaker may look familiar to you since he did a fantastic presentation for us in 2023 on compliance pitfalls with regard to surplus lines. Today, Lorenzo Houston is taking us back to the beginning to provide a brief history of the development of surplus lines market, an overview of the challenges and opportunities in the regulatory landscape of surplus lines. He is the Assistant Manager for Surplus Lines at Resource Pro Compliance, and his expertise includes an impressive 13 years as a leader in this industry. Please join me in welcoming back to our virtual stage, Lorenzo Houston.
Thanks, Julie. That was awesome. I hope everyone is doing fantastic on this incredible Thursday. Let's go ahead and jump into the presentation. Okay, so the first thing we want to do is kind of give you a brief introduction of what surplus lines actually is. So surplus lines falls into the non-admitted market. The insurance market itself is split into two different sides. You have the non-admitted and you have the admitted market. On the non-admitted market, it was created in 1890 for high-risk insurance and insurance that the regular insurance market deemed was too risky to cover. Also, things that will fall in the non-admitted market are kind of coverages that there's not enough information on. And before a policy can even be placed in a non-admitted market, it has to first be attempted to place with an admitted carrier. Another thing that we kind of want to make sure that you understand, which we'll get into in a little bit more detail a little bit further on, is that surplus lines is not covered by the state guarantee fund. That is very important for the insured to understand that. So let's explain the insurance market. So the way the insurance market operates right now, we're in what's considered a hard market. A hard market can basically be defined as a period of rising rates and coverage becoming difficult to obtain. Right now, we're currently in the longest hard market in history. We've been in this market since 2019. Every year, we're seeing double-digit rates increases. And what happens is the standard property and casualty carriers start raising prices and shedding unwanted business. And guess who's there to catch those policies? The non-admitted market. Challenging conditions on property and commercial, growing claim costs from catastrophe losses, higher hazards, evolving risks such as cyber and environmental liabilities. All of those things cause the hard market to expand and cause the insurance market to continue to harden. And what happens is surplus lines, more policies get pushed to the surplus line market. So that's where we are today. Before you could even sell an insurance policy, especially surplus lines, you have to make sure that you're licensed. But who needs to be licensed? So under the Uniform License Standard, a producer who wishes to engage in the sale of surplus lines insurance must first obtain your surplus line producer license. That requirement is that the resident producer hold both property and casualty lines of authority before a surplus lines insurance producer license can be issued. By a rule of thumb, if you're selling, soliciting, or negotiating the sale of insurance, you should contain your license. It's very, very important to make sure that you get that license before you start selling insurance. We're going to take just a brief moment to kind of go through some of the surplus line policy life cycles. Of course, the selling of insurance policy starts with an insured wanting to get something covered. They'll go to their retailer. It could be a large retailer. It could be your local insurance company that's right down the street. The retailer is going to attempt to place that policy with the carrier. Now, in surplus lines, sometimes the retailer will hold their surplus line license and they'll have direct relationships with the carrier. In many different ways, in many different cases, the retailer doesn't have their surplus line license. They have a property and casualty license, and they're dealing directly with an MGA or with a wholesaler who specializes in particular coverages and niche markets, and they have the relationship with the carrier. So that's where the middle two relationship or policy flows kind of work. Sometimes the MGA will work directly with the wholesaler if they have a particular product that they're selling, and sometimes they don't. But more often than not, it starts from the insured going to the retailer, who then goes to a wholesaler or an MGA. Now, the last relationship we kind of want to discuss is when the insured goes directly to the carrier. This type of transaction is known as independent procured coverage. Not all states allow independent procured policies, but a lot do. And in many ways, this type of procurement is only when a licensed surplus line broker or insurance agent is not involved. Before a policy, as we kind of mentioned earlier, before a policy can even be placed in a surplus line market, what's known as a diligent search must be performed. Diligent search, sometimes you'll hear it called diligent effort, is when you attempt to place a policy in the admitted market by contacting three different carriers, and then at that point, if your coverage is declined, your policy will then be placed in the non-admitted market. There are exemptions to performing the diligent effort. Many of the exemptions, one of the biggest ways to avoid having to go through that requirement is the export list. Now, like everything in surplus lines, everything is kind of state specific. Not all states contain or offer an export list. There's also the exempt commercial purchaser, which is defined by the NRA. If the insured meets certain requirements, then you can forego that diligent search requirement. It's sort of similar to the ECP. Some states still maintain their own laws regarding industrial insured. So if your insured is considered an industrial insured, then you do not have to perform the diligent search. Many states have kind of lessened the burden of getting into the surplus line market by foregoing the diligent search effort altogether. There's many states that have just simply removed that requirement from their surplus line laws and legislations, or they've made no mention of it to make it easier to access the market. Determining the home state. This is extremely important when it comes to filing in surplus lines. Now, for those of us who have been in surplus lines for a very, very long time, I'm sure we all can speak to the days pre-NRRA. So the NRRA the Non-Admitted in Reinsurance Reform Act, was passed in 2010 as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act. This law basically states that only the home state of an insurance policy may require taxes on that policy. Before that, if you had an insurance policy that covered 20 different locations, 20 different states, that was 20 different insurance policies 20 different filings that you were going to have to make for that one particular policy. As you can imagine, it could be a real nightmare when you're dealing with certain coverages, certain policies that contain multiple locations. The NRA also defined that only the home state of the insured may require that a producer has a surplus line license as well. The home state rule essentially is, if the insured is an individual, the home state of the policy is determined by the principal residence. If the insured is a single entity, then the home state is defined as the primary place of business. Now, if the insured is a group of entities, the home state is the entity that has the largest percentage of premium. That is what you would consider the home state. If there's no risk in the insured's home state whatsoever, the state that has the greatest percentage of taxable premium, or TIV, total insurable value, would be considered the home state. Once again, it is very important that you make sure that you get that part right, because that defines everything. That defines your taxes, that defines the laws that you're going to have to abide by. And the last thing you want to do is be operating in reverse and realize that the policy that you just placed does not meet the specific requirements of that state. Choosing the correct carrier. Now, just because you have a relationship with the carrier, that does not mean that they're appropriate for placing business in the surplus line market. I want to point out that non-admitted carriers are unlicensed, they're not unregulated. Carriers must meet the requirements established by the NRRA. The NRRA set very strict requirements on what carriers must meet. And if you're not sure what those if you're not sure you're wanting to get involved or whatever the case is, I definitely encourage you to familiarize yourself with those requirements. Additional requirements of the surplus line carrier you're wanting to do business with: they must be authorized to do business in their domiciliary state. They must be on the NAIC quarterly listing of alien insurers, and they must be on a state-approved carrier list. Now, again, this is surplus lines we're talking about after all, so not all states maintain their own state-approved carrier list. If they don't maintain their own approved carrier list, as long as they own the NAIC quarterly listing of alien insurers, you should be good to go. Disclosure requirements. Now, disclosure requirements are very important in surplus lines. For every surplus line policy placed by the insured must receive a disclosure that the policy has been filed in the surplus line market and not covered by the state guarantee fund. This is extremely important for the insured to understand. And it's important for you to make sure that you're able to communicate that information with them effectively to prevent them from panicking when they see that. Unlike the admitted market, in the non-admitted market, if your insurance company that you're writing with goes insolvent, or for whatever the case is, then claims can't be paid out because it's not paid by the state guarantee fund. So the insured must know that. They must be made aware of that. I provided two different examples here because every state has their own requirement, whether it's state stamp, whether it's a form that must be delivered to the insured. But here are two examples of state stamps that for Tennessee and Louisiana. As you can see, for Tennessee, the wording is very specific. It just generally states that the insurance contract is with an insured not licensed to transact insurance business. And then for Louisiana, there's a lot more detail included in their disclosure. The insurance policy is delivered as a surplus lines coverage under the Louisiana Insurance Code. In the event of insolvency, the policyholder claimant is not covered by the Louisiana Insurance Guarantee Association. So as you can see, they're vastly different. Every state has their own requirements. Some states require that your stamp be a certain size. Some require that it be a certain font so that it stands out from the rest of the policy. And again, going back to some of our, to some of the old timers, I guess you could say, of surplus lines. If you've been doing surplus lines for a long time, you may remember back when, there were physical stamps that actually had to be done, that you actually had a rubber stamp that you would place on a policy before delivering it to the insured. When the stamping offices were generated, a lot of times the stamping office would stamp the policy, and then that policy would have to be released to the insured once they do it. Now, most stamps are electronic, so you can grab those, save them, put them on the policy, and make sure that they're delivered to your customer that way. Payment of taxes. Now, a lot of people don't understand, but as soon as you get your insurance surplus lines license, the compliance clock starts immediately. It doesn't necessarily matter if you've placed any policies. It doesn't necessarily matter if you filed a lot of policies. It's the date that your license becomes effective, the compliance clock starts. Every surplus line policy placed must be filed according to the laws of the home state of the insured. So the two main regulations when it comes to surplus line policies are filings and reports. Filings and reports are different. Filings are taking the insurance policy and submitting that information to the state according to their requirements. Many states have an online portal that you can submit the policy information to. Some states have simplified the process where they collect maybe 5, 6, 7, 8, fields of information. And some states have a variety of forms that they require to be signed by the insured or the producing agent, and then uploaded along with the policy. What they're going to do is they're going to verify that the policy is filed, that the information that you submitted is correct according to their laws. And if it's not, they're going to reject the policy. In states like New York, once they've done their verification process, they're going to stamp the policy themselves, and then you have to take that stamped policy and return it to the insured. The insured should not receive a copy of the policy until the policy has been stamped and approved by the state of New York, as an example. The other regulation that we want to talk about is reports. This is where your payment of taxes come into play. Tax reports are going to fall into a variety of categories. So the first one, of course, is tax reports. Every state has a tax rate associated with a policy being placed in their state. There's also stamping fee reports. Again, not all states have a stamping fee, but if the home state of your insured is a state that has a stamping fee rate, you have to make sure that you're paying the stamping fee reports. There are other report types. States like Kentucky has municipal taxes, so you'll have to pay taxes at the city or the county level of the location of the insurance policy. There's in kind of how I mentioned earlier, just because you've played policies or you have no policies that have been placed on your license, that does not necessarily mean that there isn't a requirement. There are a lot of states that require 0 reports, which basically are you submitting a report to them stating that there has been no policies placed on your license. Non-compliance can be costly. It can absolutely be costly. It is important to understand your surplus line compliance requirements begins the day you obtain your license. The risks associated with non-compliance can escalate quickly. Some of the consequences include fines and penalties, sanctions, and you could lose your license if you haven't met the requirements of you haven't paid your taxes. There are many states that will not renew your insurance license if you have not paid your taxes or your taxes are not up to date. Just as an example, California will charge 10% a 10% penalty on any taxes that are submitted to them late. There are states that will will assess a penalty that increases every single day, $25 per day, for example, and it can max out to $500. So some of the fines and penalties that are associated with surplus lines can escalate very quickly. If you receive a sanction, which is basically an admin action, then you have to make sure that you're reporting that information to all of the states so that every state is notified that you have received this action. It's something that kind of sticks on your license and follows you around. So once you've got that mark on your license, it's kind of there. So you kind of want to make sure that you're giving the correct amount of detail and the highest level of priority to your compliance. We understand that for insurance, your job is essentially to sell insurance policies. Completely understand that, but compliance is equally as important because it can damage your reputation. And not only that, but it can prevent you from selling insurance policies in the future. We're going to discuss some of the regulators of surplus lines. So the surplus line industry has multiple regulatory authorities. Regulators really do want to help you stay compliant. Do not be afraid to contact them if you need any assistance or have any questions. I know it can be scary to contact a regulator. Trust me, I get it. But they are there to help you. They are there to assist you. So the first category we're going to talk about is stamping offices or surplus line associations. These are not every state has these, but a lot of the premium written in the surplus line market will flow through stamping office or SLAs. They're states that have the largest percentage of premiums, the largest, the largest amount of surplus line policies being written through them. A lot of them have established surplus lines associations or stamping offices to help facilitate that process. So they act as a broker between the state insurance departments and the broker. Excuse me, they act as a buffer between the state insurances department and the broker. They're designed to help facilitate compliance. They're non-governmental, comprised of surplus lines experts. So if you need any assistance with surplus line laws or specific details when it comes to a specific coverage, contact them. They are absolutely there to help. They are there to help you understand the laws and regulations of the states you are trying to write business in. Another, the main, regulator is the Department of Insurance. They regulate insurance to protect the consumers. They're where the laws are going to come from. They're where, if an insurance, a state does not have a surplus line association or a stamping office, the policies are going to flow directly through the Department of Insurance in many cases. And the last one we kind of want to talk about is the Department of Revenue. Now, again, just like everything else in surplus lines, not every single state has all three of these, involved at the different levels. But if you do have to reach out to either one of them, or you have any one of them contact you because you're writing business in their state, you kind of need to understand who these agencies are and what their role is in the insurance regulations. The Department of Revenue is designed to help consumers meet and understand their tax liabilities. Think about them as the IRS. They regulate multiple taxes. For some states, you have to pay your taxes directly to the Department of Revenue. And that is it for me. Julie?
Okay, we do have a question. Any idea why Florida does not allow surplus lines reciprocity with resident New York surplus lines licensees?
Yes, so that's a very fun topic. We have had this conversation quite a few times with both New York and Florida. It has been an ongoing thing for a long, 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 long time. It is my understanding that one state does not think that the other state's requirements are strict enough, and so they don't reciprocate with that state, and as a result, the other state does not reciprocate with the other one. So it's one of those things that for the longest time, many people have run into that issue. You have to find ways around, whether it is finding a broker that is licensed or not, a non-resident Florida broker, or whatever the case is, in order to get your New York license. But yeah, this has been a long ongoing thing that I really don't know will be resolved anytime soon.
Okay, I'm not seeing any other questions at the moment, but I do want to bring to everyone's attention that SILA is offering 7 virtual pre-conference classes in August, including 2 classes on surplus lines. They're public classes. Conference registration and or membership is not a requirement, and you can enroll by visiting the SILA Foundation website. And I'm not seeing any more questions. So, Lorenzo, thank you so much for sharing your expertise on the importance and unique requirements of surplus lines. Also, for being such a great friend to SILA and the SILA Foundation. We really do appreciate you and your time this afternoon. As a reminder to all our participants, our webinars are free of charge and open to the public, and we appreciate sharing our invitations with your colleagues. Please watch for and complete the post-webinar survey and plan to join us in June for a discussion on protection of vulnerable adults. And with that, I wish everyone a great afternoon.